We have been invited by one of our subscriber in our channel community to determine between two individuals where one invests a lump sum of 1.2 million in a money market fund. Another person invests annuities, all amounts of 100,000 per month for a period of 12 months, summing up to the same amount of capital of 1.2 million. The two investments will run for 12 months. We are required to determine which of these two individuals or investors will earn more money in terms of interest, or which investment account in these two scenarios will earn or generate a higher amount of interest of an investment period of 12 months. The question posted or the challenge given does not specify the amount of interest that we shall expect from this fund, but having gone through several money market funds through our reviews, we are going to use a return or an expected yield of 12% and assume that this money market fund compounds interest on a daily basis. We could also have chosen a fund that is compounding or distributing interest on a monthly basis, but we choose to maximize the return by increasing the number of frequencies or the number of times interest shall be distributed, and therefore forming part of the principle, expanding the effect of compounding. And for that reason, we settle for an account or fund that generates and compounds interest on a daily basis. Fast forward, before we look at the calculations, there are two important things that we need to have in mind, because the calculation or the figures, the single figure that we shall get out of the calculation conclusively confirms what we should have theoretically. And therefore, the two facts are, in finance and accounting, there are three modalities of accounting, where we have management accounting that serves decision making, we have financial accounting for performance reporting, and tax accounting. This question lies squarely in management accounting, where in management accounting, the important factor is that we use marginal data. Therefore, for comparative options or scenarios like we have in this case of a lump sum investment over 12 months yielding 12% in return, and another option of annuity investments of 100,000 over an equal period of 12 months at the same rate of return, we are supposed to look for uncommon data. The data in question here is, we have to look at the amount of capital or the capital that is invested, and in option 1 we have 1.2 million lump sum, and option 2 we have 100,000 annuities over equal period of time, and therefore that first data is uncommon and therefore qualifies for analysis. The other one is the rate of return applied in the two cases is the same, so that is not very significant. The money market fund qualities, the option of compounding on a daily basis for the two options again will not be very significant. Then there is the time question, the duration that these amounts or capitals shall be in investment. The first one, the amount of capital of 1.2 million lump sum will run for 12 months. But in the second option of annuities of 100,000, those figures, the bunches or the batches of 100,000 annuities that shall be invested throughout the period of 12 months shall serve investment time of different blocks. The first 100,000 in first month will serve 12 months. The second 100,000 will serve 11 months. The third one in the third month will serve for only 9 months. The fourth one will serve for 8 months. The fifth one serving for 7 months. the sixth one serving for 6 months, and so on. And therefore, the last 100,000 to be invested in the last month will only been invested for 30 days only. And therefore, the duration that these two options shall have in that investment is different for the different amounts invested. And therefore, again, we get another item or piece of data that is different in the two options and therefore important for our analysis. The other elements will remain the same. They will not differentiate the two options. So with the two different data, the time and amounts will lead us to the second important element, and that is compounding. Money market funds are investment options that are owned by different people that put different amounts of money in the basket, and therefore the distribution of incomes generated from that fund depend on how much each investor has sitting in the fund at different times. We have settled on a distribution of a daily basis compounding. Compounding is the factor that accelerates growth of your investment in terms of capital growth, and it is squarely tied to time. The amount may not necessarily be very important, but the amount of time that amount of capital remains in the investment determines the growth in capital in terms of compounding. Therefore, the question of time that each amount remains in the investment is the most crucial in determining the accumulated interest. And therefore, if you look at the lump sum of 1.2 million in option 1, the entire chunk of capital, the 1.2 million, is compounded on a daily basis throughout the period of 12 months, and therefore giving us a frequency or the number of times that interest has been distributed and compounded is giving us 360 times. When we look at option 2, different chunks, the annuities of 100,000 are serving different amounts of time in compounding on in the investment, and therefore they do not generate equal amount of interest for compounding. And therefore, those two factors alone conclusively inform our decision before confirmation through calculation that the lump sum invested in the same vehicle at the same yield over equal duration of time should give us a higher yield or a higher amount of interest compared to annuities over an equal period of time. That is what we will be now confirming through our calculations. And it also serves as a control. It serves purpose of control. Therefore, in the event of calculation, you can easily realize when you make a mistake in your computations. So we shall be delving into the calculations after 3 seconds break. So don't go away. Option 1, where we are investing a lump sum of 1.2 million at a yield of 12% per annum, and we are distributing the interest or compounding on a daily basis. The first step will be to determine the daily interest yield by taking the 12% per annum divided by 365 days, which results to a 0.032877, which we have truncated to reduce the error of rounding off, because we are going to compare the results of this calculation with the results of the calculations by using the mobile application of a money market fund in question. Once we apply the formula for general compounding of a lump sum, we are arriving at 1.2 million. Inside a bracket, we are multiplied by the annualized factor of 1 plus 0.03258767 divided by 100 and to the power of 365. That gives us the total amount that shall accrue in this investment in a period of 12 months. On the side, we have an attachment of how you determine the annualized factor when you are compounding on a yearly basis, biannually, daily, or monthly on the side. Once you have arrived to that figure, then your total amount that you're going to get from that amount of compounding using the calculator, we are arriving at the same value of 1,352,964, which confirms our manual calculation with this schedule that has been attached. Therefore, to determine the amount of interest that we will have generated, we will get the total amount minus our principal investment of 1.2 million, and that gives us 152,969.477 as per the calculation, and the extract from a calculation using a mobile application of a money market fund that is compounding on a daily basis. At the bottom of the extract, you notice that it is separated and showed you that the accumulated amount of investment is the 1.2 million and the total is 1.352969 as per our calculation. So that concludes or confirms that we had stated earlier that our calculation is correct as per the structure of a money market fund that is compounding on a daily basis. Those figures then will be compared with what we shall calculate in the next option for an ordinary annuity or an annuity due. In our second option with these complex formulas, we are looking at an ordinary annuity which invests a specific amount of capital, that is 100,000 annuity at the end of each month to yield to 12 purchases or investment in a 12-month period. You'll notice from the attachment, which is a calculation using the ethical money market calculator, which compounds on a daily basis for comparison purpose, that it has yielded a total amount of 1,273,769.019 after investing or contributing purchases of 1,200,000, and that is the figures that we had in the question. Those computations do not assume an annuity due, where annuity due would assume an investment at the beginning of each month, realizing 13 months of investment, and that is not what we have in the question. So for comparison purpose, if we look at the extracts from the ethical money market calculator, when you're using a lump sum of 1.2 million, and an extract of the same calculator when you are investing 100,000 each month for 12 months, giving us a total investment of the same amount of 1.2 million, you realize that option number 1, that is a lump sum investment, yields more interest compared with option number 2 as per this schedule. The finding is that option number 1, giving us an amount of 1.352 million out of the principal of 1.2 million, yielding an interest total of 152,969, and option 2, yielding an amount of 1.273 million against a principal of 1.2 million, yielding 73,769 as the interest. That leaves a conclusion that option number 1 yields more by 79,200 shillings. So investing a lump sum is giving us or yielding a higher value compared to investing annuity as per our calculation and confirmed by ethical calculation.